Wall Street's history is not merely a chronicle of triumphs and innovations, but a recurring saga of exhilaration and despair, marked by periodic financial panics that have reshaped the American and global economic landscape. These crises, far from being isolated incidents, represent fundamental lessons in market psychology, economic policy, and the enduring human tendency towards both ingenuity and excess. Understanding the unique triggers, systemic vulnerabilities, and lasting repercussions of these historical panics is not an academic exercise. It is an essential tool for traders and investors seeking to navigate the inherent cycles of boom and bust that define financial markets. By dissecting 10 pivotal panics, we uncover the intricate dance between speculation, regulation, and human behavior, providing invaluable insights into recognizing patterns, assessing risks, and formulating resilient strategies for the financial upheavals that inevitably lie ahead. The Panic of 1792 stands as the nascent republic's first true financial crisis, a stark demonstration of the fragility inherent in a newly formed market. Its roots lay in an audacious attempt by two prominent bankers, William Dewar and Alexander Macomb, to corner the market on newly issued government securities and bank stocks. Fresh from the Revolutionary War, the United States was establishing its financial footing, and the creation of the Bank of the United States, championed by Alexander Hamilton, had injected a surge of credit into the economy. This newfound liquidity, coupled with the allure of quick riches, fueled rampant speculation. Dewar and Macomb, leveraging extensive credit, sought to control a significant portion of these emerging assets, creating an artificial demand that drove prices skyward. The trigger for the panic was multifaceted. Their ambitious scheme eventually unraveled as they defaulted on their substantial loans, coinciding with the Bank of the United States' decision to tighten its credit policies in an effort to curb the burgeoning speculative bubble. This abrupt contraction of credit, combined with the public's realization of Dewar and Macomb's insolvency, led to a swift and dramatic collapse in asset prices, with government securities plummeting by over 20% within weeks. Dewar's subsequent imprisonment in a debtor's prison underscored the severe personal consequences of such reckless speculation. The enduring impact of this panic was profound, revealing the nascent market's susceptibility to manipulation and speculative bubbles. Crucially, Hamilton's decisive intervention involving the Bank of the United States purchasing government securities in the open market at a penalty rate established a foundational precedent for central bank crisis management, a prototype of the lender of last resort function that would evolve over centuries. This early episode etched a fundamental lesson into the American financial consciousness. Unchecked speculation, even in a young economy, carries significant systemic risks, and timely authoritative intervention can be critical in averting total collapse. Next, we examine the Panic of 1819, often regarded as the first major depression of peacetime for the United States. Its origins were deeply embedded in the nation's post-war of 1812 economic expansion. A period of rapid growth saw a proliferation of state-chartered banks, many of which engaged in unsound banking practices, issuing excessive amounts of unbacked banknotes and extending credit liberally. This easy credit fueled a speculative frenzy, particularly in land, as settlers pushed westward, eager to acquire new territories. The Second Bank of the United States, initially contributing to this inflationary environment, eventually reversed course, beginning to contract its credit in an attempt to rein in inflation and stabilize the currency. However, the primary external trigger for the panic was a sharp decline in global commodity prices, especially cotton, following the end of the Napoleonic Wars. European demand for American agricultural products dwindled, causing prices to plummet and devastating the nation's export-dependent economy. Domestically, this led to widespread bankruptcies among banks and businesses that had overextended themselves. Foreclosures and property seizures became commonplace, resulting in a dramatic surge in unemployment and fostering widespread anti-bank sentiment across the country. The Panic of 1819 exposed the severe consequences of a fragmented and poorly regulated national monetary system. It intensified regional economic disparities and contributed to the growth of sectionalism, as different parts of the country experienced the crisis in varying degrees and blamed different factors. The lessons drawn from this period highlighted the urgent need for a more coherent and stable national financial framework, capable of managing credit cycles and mitigating the impacts of global economic shifts. This depression showcased how an absence of effective central control over banking practices could lead to systemic instability, with devastating effects on ordinary citizens and the broader economy. Moving forward, the Panic of 1837 unfolded amidst a turbulent political and economic landscape, marked by a fierce bank war waged by President Andrew Jackson. The core causes included rampant speculative lending, particularly in land, and a sharp downturn in cotton prices, which was a crucial American export. A significant contributing factor was the absence of a central bank, as Jackson had famously vetoed the rechartering of the Second Bank of the United States in 1832, dismantling what little central financial regulation existed. This vacuum allowed state banks to issue banknotes without sufficient oversight, further fueling speculative bubbles. The direct trigger for the panic was Jackson's Specie Circular of 1836, an executive order requiring that all public lands be purchased with gold or silver coin or specie, rather than depreciated paper currency. This policy, intended to curb speculation and protect the government's finances, had the unintended consequence of devaluing paper money and causing a massive withdrawal of specie from banks, as people rushed to convert their banknotes into hard currency. On May 10, 1837, banks in New York City officially suspended specie payments, a move quickly followed by banks across the nation. The result was catastrophic. Over 40% of all banks nationwide failed, triggering a severe economic depression that persisted until the mid-1840s. This period was characterized by mass unemployment, widespread business failures, and severe deflation. The Panic of 1837 vividly underscored the profound vulnerability of a financial system operating without a central regulatory authority capable of providing liquidity and stabilizing the currency. It highlighted the dangers of political interference in monetary policy and spurred the eventual growth of more sophisticated financial instruments and, later, the burgeoning industry of credit ratings, as investors sought better ways to assess the solvency of financial institutions in the absence of federal oversight. For those who navigate the complexities of financial markets, understanding these historical precedents is paramount. Just as a seasoned mariner studies ancient charts to predict future currents, a wise investor delves into the past to anticipate market shifts. The stories of Wall Street's early days, filled with audacious schemes and spectacular collapses, are not mere anecdotes. They are foundational texts for comprehending the timeless forces at play. In this spirit, we recommend exploring 50 Years in Wall Street, the illustrated memoirs of Henry Clews. This 2-volume work offers an unparalleled first-hand account of half a century of Wall Street history, spanning from the Panic of 1857 through the tumultuous Gilded Age. Clews, a prominent financier himself, provides vivid narratives of the era's most influential figures, from the titans of industry to the master manipulators, chronicling the rise and fall of fortunes, the evolution of financial practices, and the intricate web of market manipulations that shaped the times. It's a journey through an age of raw capitalism, offering invaluable insights into the character and mechanisms of financial markets before modern regulations took hold. To truly grasp the origins of many contemporary market behaviors and the perennial struggles between ambition and avarice, you'll find a link to 50 Years in Wall Street in the description below. The Panic of 1857 marked a significant turning point, often cited as the first truly global financial crisis, its reach amplified by the nascent technology of the telegraph. The crisis was rooted in a confluence of factors: a downturn in the international economy, excessive domestic economic expansion, and rampant speculation, particularly in railroad stocks and land. The end of the Crimean War had led to a decrease in global demand for grain, causing a sharp decline in agricultural prices, which significantly impacted American farmers and exporters. The immediate trigger was the collapse of the Ohio Life Insurance and Trust Company in August 1857, a prominent financial institution that had invested heavily and unwisely in speculative ventures. This failure sent shockwaves through the financial system, eroding public confidence. Compounding the crisis was the tragic sinking of the SS Central America in September, a steamer carrying a substantial shipment of gold from California to New York banks. The loss of this vital influx of specie further tightened credit conditions and exacerbated the existing liquidity crunch. The telegraph, a relatively new invention, played a crucial role in accelerating the spread of panic, allowing news of bank failures and market collapses to travel almost instantaneously across the United States and to international markets. Within weeks, over 5,000 American businesses had declared bankruptcy, and the financial contagion rapidly spread to Europe. The Panic of 1857 starkly exposed the profound absence of a central banking system in the U.S. and underscored the urgent need for unified principles to prevent such widespread panic. It also contributed to heightened sectional tensions between the North and South, as different regions experienced varying economic impacts, further fueling the political discord that would ultimately lead to the Civil War. The crisis served as a powerful, albeit painful, lesson in the interconnectedness of global finance and the critical role of liquidity in maintaining market stability. The Panic of 1873 ushered in what became known as the Long Depression, a period of severe economic contraction that affected both Europe and North America. At its core were excessive speculative investments, predominantly in the rapidly expanding railroad industry, which had outstripped genuine economic demand. The period saw an unprecedented construction boom, with vast amounts of capital poured into building new rail lines, many of which proved unprofitable. Another significant factor was the demonetization of silver in several major economies. In Germany, the adoption of the gold standard after the Franco-Prussian War led to a massive sale of silver, depressing its value. Concurrently, the United States passed the Coinage Act of 1873, effectively ending the bimetallic standard and demonetizing silver, a move dubbed the Crime of '73 by silver advocates. This contraction of the money supply exacerbated deflationary pressures. The immediate trigger for the American panic was the bankruptcy of J. Cook and Company, one of the nation's largest and most prestigious financial houses. Cook's firm was heavily invested in financing the Northern Pacific Railway, and when it failed to sell a sufficient amount of the railway's bonds, the firm collapsed on September 18, 1873. This event sent shockwaves through Wall Street, leading to a cascade of bank failures and a temporary closure of the New York Stock Exchange. The panic was also intensified by the collapse of the Vienna Stock Exchange earlier in the year, signaling a broader global financial instability. The Long Depression that followed was characterized by widespread bankruptcies, mass unemployment, and significant labor unrest, including major strikes. This crisis highlighted the immaturity of monetary supply regulation in an industrializing capitalist system and spurred a greater understanding of the need for more robust financial oversight. It also contributed to the consolidation of industries, as smaller, weaker firms were absorbed by larger, more resilient ones during the downturn, setting the stage for the rise of powerful industrial trusts. The Panic of 1893 was a severe economic downturn rooted in a complex interplay of international financial instability, domestic monetary policy debates, and unchecked industrial expansion. A central cause was the ongoing debate over the bimetallic standard, gold and silver, and the detrimental effects of the Sherman Silver Purchase Act of 1890. This act required the U.S. Treasury to purchase large quantities of silver, which was then paid for with gold-redeemable Treasury notes. This policy steadily drained the nation's gold reserves, undermining confidence in the stability of the dollar and leading to fears that the U.S. would be forced off the gold standard. Simultaneously, the railroad industry, still a dominant force, had continued its unchecked expansion, leading to overcapacity and unsustainable debt levels. The trigger for the panic was multi-pronged. The bankruptcy of the Philadelphia and Reading Railroad in February 1893, followed by the National Cordage Company in May, signaled deep structural problems in key sectors. These failures, coupled with a growing lack of confidence in the U.S. monetary policy, prompted European investors to withdraw substantial funds from American markets, further depleting gold reserves and tightening credit. The result was a dramatic collapse in stock prices on the New York Stock Exchange, widespread runs on banks, and hundreds of bank failures. The ensuing economic depression, which lasted until 1897, was one of the most severe in American history, characterized by extremely high unemployment rates, estimated at up to 18 to 19% in some areas. The Panic of 1893 exposed the profound fragility of the 19th century financial system, particularly its vulnerability to monetary policy inconsistencies and international capital flows. It ultimately led to the repeal of the Sherman Silver Purchase Act, a move seen as crucial for restoring confidence in the gold standard and stabilizing the nation's currency. The crisis demonstrated the critical importance of a stable monetary policy in maintaining economic confidence and preventing systemic collapse. The Panic of 1907, often referred to as the Bankers' Panic, stands as a pivotal moment in American financial history, directly leading to the creation of the Federal Reserve System. Its origins lay in a severe deficit of international liquidity and rampant speculation on the stock market, exacerbated by inadequate regulation of the burgeoning trust companies, which operated with fewer restrictions than traditional banks. These trust companies had become major players in the financial landscape, often engaging in risky lending and speculative investments. The immediate trigger for the panic was a failed attempt by speculators F. Augustus Heinze and Charles W. Morse to corner the market on shares of the United Copper Company. Their scheme collapsed spectacularly, leading to a crisis of confidence in Heinze's bank, the Mercantile National Bank. This sparked widespread fear and a massive run on deposits at the Knickerbocker Trust Company, a large and prominent trust company with close ties to Heinze. When Knickerbocker Trust failed to secure sufficient liquidity and was forced to suspend payments on October 22, 1907, it sent shockwaves throughout the financial system. The New York Stock Exchange plummeted by nearly 50% from its previous year's peak, and runs on other trust companies and banks became widespread across the nation. With no central bank to act as a lender of last resort, the financial system teetered on the brink of complete collapse. It was at this critical juncture that J.P. Morgan, the titan of finance, stepped in. He personally organized and rallied a syndicate of private bankers, leveraging his immense personal wealth and influence to provide emergency liquidity to solvent banks and trust companies, essentially acting as a one-man central bank. Morgan's decisive intervention, though effective in stemming the immediate crisis, powerfully demonstrated the inherent flaws and dangers of a financial system reliant on private individuals for stability. The panic served as a powerful catalyst for political will, directly leading to the passage of the Federal Reserve Act in 1913 and the establishment of the Federal Reserve System, designed to provide a centralized, stable source of liquidity and regulatory oversight, thus fulfilling the role Morgan had temporarily assumed. The Wall Street crash of 1929 and the ensuing Great Depression represent perhaps the most devastating financial crisis in modern history. The underlying causes were deeply systemic. Widespread market speculation, fueled by an expansion of debt and the practice of buying stocks on margin, where investors purchased shares with borrowed money, often as little as 10% down. This led to an unsustainable overvaluation of stocks, far beyond their intrinsic value or the underlying economic fundamentals. Low interest rates during the preceding years had encouraged this speculative fervor. The immediate trigger was a series of catastrophic trading days in October 1929. Black Thursday on October 24th saw a sudden massive wave of selling leading to a sharp market decline. Although some bankers attempted to intervene, their efforts were insufficient. The real collapse came on Black Tuesday, October 29th, when millions of shares were sold in a panic, overwhelming the market and sending prices into a freefall. The Dow Jones Industrial Average plummeted by an astounding 22.6% in a single day, marking the largest single-day percentage drop in its history at that time. This collapse was exacerbated by a growing loss of investor confidence, as signs of economic trouble such as industrial overproduction and declining consumer purchasing power became increasingly evident. The crash precipitated the Great Depression, a decade-long economic catastrophe that lasted until 1939. Billions of dollars in wealth evaporated, leading to mass bankruptcies among businesses and, critically, among banks. By 1933, approximately 9,000 of the nation's 25,000 banks had failed, wiping out savings and exacerbating the credit crunch. Unemployment soared to an unprecedented 25% in the United States. The profound impact of the 1929 crash led to radical shifts in economic policy and regulation. It spurred the adoption of federal regulations aimed at stabilizing markets and curbing uncontrolled speculation, most notably the Glass-Steagall Act of 1933, which separated commercial and investment banking, and the creation of the Securities and Exchange Commission, SEC, to oversee financial markets. The lessons learned from this period fundamentally reshaped the role of government in regulating the economy and protecting investors, aiming to prevent such a catastrophic collapse from ever happening again. The Black Monday crash of 1987 marked a new era of financial panic, one profoundly influenced by the advent of computer trading and global market interconnectedness. The underlying causes included an overvaluation of stocks following a prolonged and robust bull market. This was exacerbated by new financial innovations, particularly program trading and portfolio insurance. Program trading involved large, automated sell orders triggered by specific market conditions, while portfolio insurance was a strategy designed to protect portfolios by automatically selling futures contracts as the market declined, effectively amplifying downward pressure. Macroeconomic concerns also played a role, including growing U.S. trade and budget deficits and rising interest rates. Furthermore, the increasing globalization of financial markets meant that a shock in one major market could rapidly propagate worldwide. The immediate trigger was a confluence of factors that created immense selling pressure. Markets had already experienced a 10% decline in the week leading up to Black Monday, creating an atmosphere of nervousness. A minor geopolitical event, an Iranian missile attack on a U.S. military ship, served as a psychological nudge. However, the sheer speed and magnitude of the crash on October 19, 1987, were unprecedented. The Dow Jones Industrial Average plummeted by 22.6% in a single day, the largest one-day percentage drop in its history. This was not a slow decline, but a lightning-fast collapse, primarily driven by the automated selling mechanisms of program trading and portfolio insurance. Global markets swiftly followed suit, experiencing significant, albeit slightly less dramatic, declines. The profound impact of Black Monday was its revelation of the critical role that financial and technological innovations could play in amplifying market volatility. It highlighted how computer-driven trading, while offering efficiency, could also create unforeseen systemic risks. In response, regulators quickly implemented circuit breakers, temporary halts in trading designed to prevent panic selling and allow market participants to reassess. The Federal Reserve also intervened swiftly, injecting liquidity into the banking system by lowering interest rates, demonstrating a more proactive and coordinated approach to crisis management than in previous eras. This event fundamentally altered market structure and regulatory thinking, emphasizing the need for safeguards in an increasingly automated and interconnected global financial system. Finally, the global financial crisis of 2008 represents the most recent and arguably the most complex systemic breakdown in modern financial history, rooted in the speculative excesses of the housing market. The primary causes were rampant speculation on rising real estate values and the widespread issuance of subprime mortgages, loans extended to borrowers with poor credit histories who were unlikely to repay. This predatory lending was facilitated by severe deficiencies in financial regulation and an insatiable demand from the investment banking sector for these loans. Crucially, These subprime mortgages were then securitized into complex derivative instruments such as mortgage-backed securities, MBS, and collateralized debt obligations, CDO, which were then sold to investors worldwide, often with misleadingly high credit ratings. This obscured the underlying risk, distributing it across the global financial system. The trigger for the crisis began subtly in early 2007, as rising interest rates made adjustable-rate mortgages unaffordable for many subprime borrowers, leading to a surge in defaults and foreclosures. As housing prices peaked and then began to fall, the value of the underlying collateral for these MBS and CDOS evaporated, causing these once highly rated securities to become toxic. The crisis reached its crescendo in September 2008 with the dramatic bankruptcy of Lehman Brothers, a prominent investment bank with massive exposure to these toxic assets. This event sent shockwaves through the global financial system, triggering a collapse in stock markets, a freezing of credit markets, and widespread runs on financial institutions. Other major firms like Bear Stearns were forced into emergency sales, and the insurance giant AIG required a massive government bailout. The impact was a deep and prolonged global recession, often referred to as the Great Recession. Millions of people lost their jobs, countless businesses failed, and household wealth plummeted. The crisis prompted unprecedented government interventions, including the Troubled Asset Relief Program, TARP, in the U.S., and massive fiscal stimulus packages like the American Recovery and Reinvestment Act, ARRA, along with coordinated efforts by central banks worldwide to prevent a total systemic collapse. The lessons learned were profound. The crisis exposed the dangers of deregulation, the systemic risks posed by complex financial instruments, and the critical importance of robust oversight and consumer protection. It led to significant regulatory reforms, such as the Dodd-Frank Wall Street Reform and Consumer Protection Act, aimed at strengthening lending standards, increasing transparency, and protecting the financial system from future crises. It also underscored the vital role of independent regulators, free from political pressure in safeguarding financial stability. The history of Wall Street's panics reveals striking commonalities that transcend individual eras. Recurring themes of speculative bubbles, fueled by excessive credit expansion, inadequate regulation, and the powerful psychology of the crowd, consistently emerge as the primary drivers of these crises. From the nascent market's vulnerability in 1792 to the complex systemic risks of 2008, the human tendency to chase unsustainable gains, often ignoring fundamental risks, remains a constant. However, the evolution of the response to these crises is equally significant. Early interventions were often ad hoc and reliant on the actions of powerful private individuals, such as J.P. Morgan's pivotal role in 1907. Over time, these crises compelled the establishment and strengthening of centralized governmental and quasi-governmental institutions, most notably the Federal Reserve System, which evolved into a powerful lender of last resort and a key regulator. Furthermore, each crisis has led to the implementation of new regulatory frameworks, from the Glass-Steagall Act after 1929 to Dodd-Frank after 2008, reflecting a continuous, albeit imperfect, effort to learn from past mistakes and build a more resilient financial system. For contemporary investors, understanding this rich history is not just academic, it is intensely practical. It provides a crucial framework for developing resilient investment strategies, allowing one to recognize the early warning signs of market overheating, appreciate the inherent cyclicality of boom and bust, and prepare for the inevitable periods of volatility and downturn. By studying these historical precedents, investors can cultivate a more disciplined approach, resisting the siren call of speculative frenzies and appreciating the value of long-term perspective. While each crisis possesses its unique characteristics and unfolds within its specific technological and economic context, the fundamental principles of market psychology and the inherent risks of economic imbalances remain remarkably consistent. These enduring lessons offer invaluable guidance for anyone seeking to navigate the complex and often turbulent world of finance, reminding us that prudence, historical awareness, and a healthy respect for market forces are the most powerful assets an investor can possess. To further deepen your understanding of the psychology that drives market behavior, even in the most tumultuous times, we highly recommend exploring the new edition of Reminiscences of a Stock Operator. This timeless classic offers a profound analysis of the strategies and, more importantly, the psychological insights of Jesse Livermore, one of the greatest traders in Wall Street history. What makes this new edition particularly valuable are the added commentaries and analyses accompanying each chapter. These expert insights transform Livermore's legendary experiences and observations into practical, actionable lessons for today's investors. It's not just a historical account, it's a masterclass in market psychology, risk management, and the discipline required to succeed when panic strikes. Whether you're a seasoned trader or just beginning your investment journey, the wisdom contained within this book will illuminate the enduring principles of market dynamics and human emotion. Find the link in the description to secure your copy and learn from the best.